Hi, this is Tim Grant, your 5-minute QuickBooks professor. Today, discussing the differences between inventory parts and non-inventory parts. This is a common area of confusion among QuickBooks users, and I hope to explain the differences a little bit. But before we actually get into QuickBooks, I want to show a little bit about how the items are used depending on the different roles in the company. So, um, with inventory parts and non-inventory parts, both are used by purchasing agents. They frequently have to know how many do I need to order, obviously for purchase order, and when do I need to reorder? When are we going to hit the reorder points? So knowing the quantities is usually pretty important for a purchasing agent. For fulfillment in a wholesale or distribution environment or production for manufacturing, they're asking, is there enough on hand in order for me to create my bill of materials? And can I create my assemblies? Do I have enough on hand? And then finally, the third role is for the accounting department. They're not so concerned about the quantities as they are the values. They need to make sure that their inventory valuation is accurate on the balance sheet. So let me go into the accounting behind the scenes of these two items real briefly without getting too deep. Non-inventory parts, they affect the chart of accounts both at the purchase and at the sale, but in different ways to the inventory parts. For non-inventory parts, at the time you purchase something on a bill or check, it is being costed. And at the same time, usually an accounts payable is being created or maybe cash is going out from the bank. At some time later, that item might be sold, might not too, but if it's sold, it can affect accounts receivable on the customer side or cash if money is received, but it's recognizing the revenue. Realize that these two transactions can be weeks, months, even years apart and are not connected. So they're affecting the financial statements at different times. That's in contrast to inventory parts. At the time of purchase, the items are not being expensed, but instead are going to an inventory asset account on the balance sheet. And the offset is to accounts payable, or typically, or sometimes to right to the bank account. At the time of sale, the cost of goods sold is being posted. The item is being expensed at the time of sale. It is also reducing the inventory asset account for the same amount. So these two accounts from the purchase and sale zero each other out on the balance sheet. An accounts receivable for a customer is being created, or perhaps the cash is being received, and the revenue is being recognized. But the really important point here is that at the time of sale, your revenue and your cost of goods sold are being recognized at the same time. In accounting, we call that the matching principle. And this is in sharp contrast to the non-inventory part, where those events are happening at different times. So let's flip back to our QuickBooks, and let's go over items briefly. So you can see here on our item list, this company uses inventory parts, assemblies, and non-inventory parts. One thing to point out here, though, is to see the total quantity on hand. For inventory parts and assemblies, the quantities are tracked. However, for non-inventory parts, they're not. And let me show you how and why. So up here, let's look at an inventory part. There's three fields that you really need to pay attention to. One is the cost of goods sold. The second is a revenue account. And the third here, this is the balance sheet. As I was saying, this is what gets posted at the time of the purchase, and the cost of goods sold and revenue accounts will get recognized at the time of the sale. Also notice that there's a total quantity on hand because the inventory parts and assemblies are tracked by the quantity. This contrasts with the non-inventory part, which when I open it up, you can see similarly has a cost of goods sold account, which will get hit at the time of purchase, and a revenue account at the time of the sale. But there's no balance sheet. There's no inventory valuation account down here. Neither is there a quantity on hand. Now, the tools that are used here is several for the people who are obviously are using them. For the purchasing agent, they'll have a inventory stock status by item report that they'll use, and they'll track the quantities. This has a reorder points, has the on hand, and this tells them what to order. For the person who's completing the assemblies, they're going to want to know, can I complete the assemblies with the inventory on hand that I have? Again, inventory parts will have a quantity, and you need that minimum quantity in order to produce it. But the inventory parts do not require the quantities. So one final item is that realize when you're looking at whether it's an inventory part or a non-inventory part, is there a value to it? Do I want to have to count all of these items at year end in order to keep my quantities and my value of my items correct? And that's it. That's the difference between inventory and non-inventory parts. My name is Tim Grant, your 5-Minute QuickBooks professor. Thank you for joining us.